What's up, founders and investors? Welcome back into Next Round Ready. I'm your host, Chris. Today we have Ethan from Palafox Ventures. Ethan, welcome to the show.
Thanks so much. It's great to be here.
So, before we get too deep into, I think, a little different conversation about funding today, I'd like to get a little background on the investors and the people that I talked to. So, how did you get to where you are now, being this active in the startup world?
Yeah, so I'll give you the very condensed version because my path is a typical entrepreneur path, not a typical investor path, which means that it's circuitous and sinuous and windy. I went from engineering physics to TV production to private equity. I was an operator, so my big thing was operating companies. I actually started my very first job in post TV production. So I was a TV producer in New York City for 6 years. I was in competitive intelligence research, eventually turned that into a consulting firm, which I sold. And then I was a founder of a company out in London. I led a corporate venture arm. So I've kind of done everything in venture. By the time that the investment side of it picked up several years ago, I'd already founded companies, operated at failed companies, helped corporate venture arms, done the whole 9 yards. I mean, I've done almost everything in venture. And
Wow.
then a couple years ago, it made sense that I started making a couple of small angel investments. And then I got involved with a wonderful venture capital firm, Fairbridge, out of New York City. Became a venture partner there and really picked up because I really wanted to understand. It's my deeply sort of curious nature, understand like everything. So understanding both sides of the table, I can understand it from a founder. It made me really good at sourcing and due diligence. And I not necessarily great at investing, so that was a skill set that I needed to still learn. But that's life, right? We're always learning.
Yeah. Yeah, I think we always have to learn something different. But I think it's always interesting how many engineers I see that go from engineering at some level in something into eventually investing. I've talked to
Yep.
maybe 20 of the investors I've interviewed have been engineers at some point. It's probably one of the more, I would say, the patterns I see in this space.
Yeah, I mean, from a on a professional investment side, most of my colleagues were actually not engineers, nor were they even operators. Most of them have much more of a financial background, which does make you look and analyze at a company differently. And I'm not really an engineer, I'm more of a product person and a strategist. So, and we bring those biases, and I can't call it anything else other than a bias. Like I look at a company and the first thing that I'm going to notice is product and business strategy sales. Like that's the first thing that I'm going to see. Can this company actually sell to customers and what's the kind of roadmap of the product? Whereas one of the things that I had to
Yeah.
unlearn some of that, I had to actually unlearn some of that to make smarter, more unbiased, more rational decisions about investing because it is about numbers, right? It is about projecting out multiple rounds and seeing the valuations and the cash flows and much more on the financial side of things. I was actually a little bit floored how few operators there actually are in venture capital. Different firms try to gravitate towards others, but there's actually a lot less than you'd think.
No, I agree. I agree. And I think it's kind of like a two-sided problem. On the founder side, a lot of them don't have the strategy you're talking about. Like it shocks me how many founders I talk to who don't have like their business model nailed down. They're like, "Oh yeah, we want to raise capital." I'm like, "Okay, well, how do you make money?" And they don't have an answer. It is mind-blowing. It's like, "Well, how are you going to ask me for money if you don't know how you're going to make my money back?" That doesn't make any sense. That part just it confuses me often.
Yeah, and well, and then as a founder, I did not really appreciate and understand the gravity that most venture capital, well, all venture capital is a business. The small emerging funds are just a small business like me, and they actually have to go raise funds just like I do. And they also have a pitch deck just like I do. And there's actually
Hmm.
almost no difference between what they're doing and what I'm doing. Obviously, the product is different. They're selling access to deals, and I'm selling access to a problem, a solution. But I'm like, wait a minute, these are just basically two startups that are communicating to one another, and you feel like there's an asymmetric power balance. The startup feels that the investor has the cash. Immature ones, I'll say, inexperienced ones. But
Yeah.
venture believes that the asymmetric power actually revolves around the founder because a really good founder will have their choice of capital options, including even things beyond venture capital. So it is both of them are businesses just trying to get by as part of this, grinding wheel of entrepreneurship that we've created for ourselves.
Yeah, man. And I'm excited to talk about these different options in terms of what founders can use to fund their companies. We often see, and I think for a while it's been equity investment. And that's probably, I don't think it's really arguable or debatable that it's the most popular investment format for startups. But now it's so many different things that are at play. And I'm excited to get into this.
Yeah. So I think there has been a general one playbook, but we have to take one step back to make sure that we're all speaking the same language and the same definitions. Because one of the things I realize is I've talked about this world, I talk about capital innovation. So I'll start with a basic definition of what is capital. So capital is not found in physics or chemistry. It's a human invention. It's what we call a coordinating technology. And when you sell a share of a company, by the way, that dates all the way back to the Dutch East India Company, if you can believe it, 400 years ago. Basically, the quickest version of the story is food was terrible. There are these islands called the Spice Islands. We call them Indonesia, that had spices that made the food less terrible. If you sent a ship out there and captured the spices, you made lots and lots of money. But it was very expensive to send a ship, so they had this idea, what if everyone chipped in a bit to send the ship out there and then got a share of the profits that the ship came back? It's literally the modern foundation of all private equity. Even the word called carry, which investors use, was the amount that the captain of the ship was able to pull aside for themselves as a benefit of going on the ship.
Well, wait, so you're saying that a GP is essentially a pirate? Is that what you're saying?
Not a pirate. Pirates are unauthorized. These were authorized ship captains, but we can call them pirates. No, they were authorized. They were authorized naval captains that whose job was to steer a crew to the Spice Islands, pick up the spice, and make sure it gets back. And for that, they would get carry, and that's where the GPs come from. So 400 years of private equity, and that became public markets. Everything we know about the stock market became private and public equity. Remember, there's two different kinds. The stock kind that anyone can invest in. Literally go in Robinhood, you could buy a stock of Ford. That's public equity. And then, OpenAI, which is you can't go to OpenAI and buy that. Ignore the possibility of your friend's secondary market. That's called private equity because it is not available openly and publicly to everyone. This is 400 years worth of information. And then about 75, 80 years ago, venture capital split off of private equity. Venture capital is private equity, but it has a very specific definition. So now we've arrived. So the first point is capital can be innovated. We can do whatever we want. It's a technology. We created it. We can change it. We have changed it. It has gone through changes, and it will continue to go through changes. So what is venture capital? At its very simplest core, it's actually only a couple of things to have definition. What it was back 60, 70, 80 years ago, the technology companies of the day realized that if you build something once, you could sell it forever. That was like a common trait of it. And the modern equivalent, if you think about it, is like Instagram it doesn't cost Instagram a lot to get the next user. It's the incremental, there's very much an incremental use a marginal cost for the next user. That's the basis of venture capital, which means, Chris, if I gave you $1 million and you coded something, you built something that you could sell 1 million times over, we would all become unfathomably rich, like just ridiculously rich. Compare that to a modern company where it's like every time you build a car, right? Pick a number. It costs $20,000 to build a car. You sell it for $30,000, right? $10,000 profit. If you just sell more cars, you just get the same $10,000 profit. Like nothing changes. It's a linear cost model. Whereas in software, if we sell it to 2 million people, we have like double the amount of profit, like because it doesn't cost that much to deliver. So that was the basis of venture capital. And it has served us really well, and so it requires the marginal cost. It also requires going after global markets. You've got to go after something really big because it doesn't make sense because you're going to need a lot of money to scale, and you need really big outcomes. The modern equivalent is unicorn chasing or decacorn chasing.
Yeah.
So this was the basis of modern venture capital, and I think we taught an entire generation of founders, or we tried to, that this was the only way. Sure, there were a couple of other ways you could have taken debt, but that's weird, and that's if you're not really good and you can't get venture capital. And you could try to build. We actually told people, it was crazy. We told people that if you built a profitable, sustainable business, that you were just a lifestyle business. You weren't actually a real entrepreneur. because you weren't trying, right? We called you a lifestyle.
That's
business.
always been mind blowing because it's like almost like I don't know what to call it, but tech bros or the bigger investors use the term lifestyle business in almost a demeaning way. I don't think it's always purposeful, but it may come off that way to founders sometimes. But I do agree with you 100%. Yeah.
Oh, I mean, you build a $30 million business and you're pulling $2 million a year, and someone tells you that you're a lifestyle business. And because you're not making $1 billion and you can't return $1 billion to an investor. So that's fine. But these are the basics of venture capital. So where does that work really, really well? It works when you're going after a globally driven business in which you can have appreciable market share in a relatively short amount of time, A, or B, something where it's got incredible IP that's truly protected. So for example, the two things that I can think about really quick is like how fast like Uber took off and was able to disrupt the taxi market globally in multiple countries all at once. And there were like 4 or 5 Ubers around the world. There's Lyft, there's a couple more. And then also like I talked to recently some people in Fusion that are building Fusion, and the billions of dollars going to Fusion because the thought is that the first company that can actually make Fusion will probably have like $1 trillion return. So that's worth like the gamble, because it is gambling a little bit, right? You are betting. The rule of the power law, which dominates unicorn chasing, is that one company will get outsized returns and many others will fail. And what that results in is 90% failure, 10% loss. One company usually returns the fund. I think we've heard all that, especially in conversations here. That's the power law. And, so why it is changing. So first of all, basic definition. So now we've arrived at a place of where we are, right? And we taught generations of founders that you have one path, and that's the path. And the main mechanism for venture capital is the last part, and then I get off the boring definition, the transference of equity. So what is that? You're selling a portion of your company now at present dollars in the hope that you could resell that share of the company in the future at a higher round. Okay, so what does that mean? Well, there's only a couple ways that you could get what's called liquidity. That's how all of this game works. Traditionally an IPO, which there haven't been very many of. For stats, the private equity numbers in this country are staggering. We've basically 10x the amount of companies that are owned privately. Most startups don't IPO anymore. So, and the second way was acquisition. So that's just, somebody acquires you. Problem with acquisition is if you look at the numbers, most acquisitions aren't billion-dollar acquisitions. Most acquisitions are 50 million, 100 million, 200 million, 400 million. Great numbers, by the way, but not for investors. So so this has changed now because entrepreneurs have gotten smarter. They want more control over their company. B, funds around the world are experimenting with new and different ways to get at these brilliant founders that are doing different things. 3, liquidity has shifted. And I think what we're seeing now is emerging asset classes. We're literally seeing innovation in real time. We've been tracking. So I started this thing about 6 months ago called Post-Unicorn Capital. And it's just trying to track these changes because I started witnessing it. I travel the world for my work. And there's over 60 funds right now that I would say that are already in venture-adjacent territory, where it looks and smells a little like venture, but often it's not unicorn model. It's something different. There's already 60 funds. That's
interesting. And so if it's already at 60, how long do you think until this becomes? I think we could agree that the funds like A16Z, Y Combinator kind of dominate the space in terms of narratives and with their innovations. How long do you think until these alternatives become more mainstream?
Depends where you are. I think to some extent in some parts of the world they already are mainstream. So A16Z, it's only like 18 or 19% of all venture capital dollars is under the management of Andreessen Horowitz right now. So like 1 out of 5. It's insane. It is already becoming normalized. What's interesting is, and I love this stuff. I'm an innovation geek, tech geek. I love emergent behavior, emergent technology, when things just happen without us planning it. I think we're already there. So there's 2 particular asset classes. There's several more, but 2 particular asset classes that I pay attention to probably closer than the other ones. One is called permanent capital, which is the idea that I'm planning for a non-exit. So and you might say it looks like debt, but it's kind of a little bit different than debt. But there's a number of firms around the world that are basically, they get cash dividends off the business. They invest in cash flow positive businesses. and they get a portion of the current and future success of the business indefinitely. And it's great for companies that don't want to necessarily exit. Many people have a great company and it's making a decent amount of money. So permanent capital is an interesting one. And the other one is called SMV, which is small and medium venture. And these are designed for portfolio construction of $50 to $500 million of exits. So it's not a unicorn exit, but it's not the power law because it's planning many more exits in a faster period of time. And again, I'm already seeing funds that are building their portfolio. Some are even on fund 2, fund 3.
That doesn't sound too bad, though. Honestly, from my perspective, it sounds like a win because in a typical VC model, I don't know if you mentioned this, but it's like a 10-year run that you're waiting for that $1 billion exit or the IPO. But if less companies are IPOing, if they're not guaranteed to make that 10-year mark if they could fail before, this might be like a nice happy medium, you know?
It is for everyone except one group. Well, put your hat on
Really?
or an LP hat. And this is the problem. And what we need is to re-educate the LPs. Because at some point, a sophisticated LP will sit there and say, look, I invest in VC as a gamble. It is a gamble. I'm going to lose most of my money, but if I don't, I'm going to make $1 billion. And if I'm not going to do that, and if I'm going to go to a safer investment, then there's a lot of vehicles. There are a lot of options. I can invest in real estate. I can invest in index funds, for gosh sakes. I can invest in a lot of things. So that's the other side of it. I have counter arguments, but I do want to recognize the other side of it, right? Which is the LP community could arguably say, look, if I'm not going to get the fantastic returns, I'm going to go invest in a commercial building. I'm going to go invest in Ford. Well, why am I going to invest in this thing that I could get, I don't invest in Ford because I can make $1 billion. Now you're giving me an option where I can make a little bit more, but I don't have to. So that's the argument. Now, it's a little bit to me of a false. Good.
I got a question for you on the LP thing though. Is that something that bothers them, or is it just like the time? Is time also a factor here too? Because something I think about when I've spoken to LPs is their timing of just getting to their exits faster is something that they've been interested in. And that's why I've literally had people tell me they don't want to go into venture because it takes so long. So I would think that something like this with, if you can cut the time in half, that might be more viable to a lot of people.
That and the 2 and 20, right? So the fees are the other problem that the LPs have. It's like, I'm not funding your lifestyle, I'm funding your acquisition. So if you do have a model that can get to acquisition faster, you can also get the cash faster, and you could possibly get the fees lower. These are all factors, right?
Yeah.
And I want to be clear. It's summer 2026. I'm not going to have all the answers now because this is being written right now in time. If you look at the country of Brazil, Brazil spent the last better part of 10 to 15 years actually retraining their LPs. And the idea there was Brazil really wanted to make a splash onto the startup scene. They're doing quite well. And they realized that they couldn't just import the Silicon Valley model. And if they went for, unicorn or bust, it would be bad for the society. It would be bad for their country. Whereas we want more people to succeed and more money sloshing around in a faster time periods. And so now the country of VC has engineered something. So to some extent, you do see some acceleration of this in other countries. Not just. I was actually surprised. So I was doing a lot of my work in emerging markets and in Europe. But you do have sections of the U.S. that act very similar to this. You've got the Midwest. I met a friend of mine who was running like interior New England, for example. So you definitely have outside of the major areas, New York, San Francisco, a few others, L.A., Miami. You do have this like need and necessity to basically innovate because we cannot. It does not serve. You could argue that it does not serve society. Maybe it can serve some LPs if you happen to be on the winning side. But even then, you're buying a ticket on the winning fund of the winning fund. So it doesn't serve society, and it often doesn't serve investors if we're chasing unicorns. Now, the other side of this, because I like giving you the other argument, is that what people will argue this is what gives San Francisco some of its power, and it's partially true.
Yeah.
I don't think unicorns will go away. I actually think venture capital is one of the most elegant economic models we've ever invented. It just has been applied too broadly and is not appropriate for many startups.
I love that right there. I 100% agree. I think it's been applied too broadly because I took a founder, really good product, really great team, traction, all of that stuff, to an investor. And they told me that this is not a good company. And I'm like, well, they're already profitable. They're doing well. And they're like, well, they'll never reach the $1 billion status because of this and that. And I'm like, well, that's true, but they can still help all of these people. They were making generators in undeveloped countries to help them with their power and all kind of stuff, using some AI stuff. It was really, really innovative. And it's really helping, people in a specific area of the world who need that specific problem to be solved. And it was kind of frustrating for me, to be honest, because I'm like, well, they're actually doing something that can change the world, but because it might not make you enough money in 10 years, you're like, this isn't a good company. And I don't know, that kind of stuff, it always rubbed me the wrong way. So I like these alternatives because I think we can improve the world on a lot of different levels. If we stop looking at it as, well, if you aren't going to make $1 billion, then we can't work with you.
Yeah, I was talking to one VC fund, and they were telling me that basically, and they're much more advanced. They're not an emerging fund; they're an established VC fund, and they already have that because they have a fund for these smaller, faster acquisition companies, and they have a fund for unicorn. So I think the future is going to be
Wow.
a bigger menu option for founders and investors being able to get in on more deals, right? So, but going back to your generator thing, I'm frustrated even more than that because I've been on that side to be like, no, so either you're not a company. Okay, well, they are. Or you go for impact investment or become a charity case. And it's like none of
Yeah.
that makes right? This is the way. And so there is a level of frustration. Now, part of that is that humans necessarily aren't the best at naming things in ontology because nobody should ever say that's a bad company. What they should have said is that company is not a fit for traditional venture as we define it, which is partially true, unfortunately, right? But I'm full of hope and optimism that we are expanding the definition of winning and success. That's, to me, what needs to happen. It's great that venture and technology has created opportunities to win, but we need to not narrow the definition of winning. We need to expand the definition of winning.
I totally agree. So let's talk a little bit to the founders directly, right? What kind of insight would you give to founders? And I guess to start off, how they could even learn about these alternative options. Where should founders begin with that?
Yeah, so the message I give to founders, speaking to founders directly, is be honest about what you want to do in your own definition of success, and do not let anyone else define what your definition of success is. I know that sounds silly, but that really matters, because if you want to be a world-class company and you want to be venture, it comes with trade-offs. It does come with trade-offs. It's less nights and less weekends. It's some missed time with the family, and no shade at all on whatever choice you make, but make a choice wide open. And at the point, if you say, I don't want that. I want less hours. I want to hang out with the family, whatever. Then you're also not going to be venture backable also, right? I'm not saying that's that stark of a choice, but like they are different choices to make. So the first one I'd say is don't, choose your own definition of success. Where are you willing to go, and what are you willing to sacrifice and give up? We can have a different debate for a different competition about work-life harmony and things like that, but the reality is if you're going to take millions of dollars to build a globally recognized brand, you're going to be working a lot of hours to make that happen. That's only fair and responsible. You shouldn't be asking people for millions of dollars unless you're willing to work really hard. So define what your success is and start working backwards from that. Say, this is my definition of success. I talk to a lot of my VC friends, and I tell them about a lot of the capital innovation stuff that I'm doing. Because, again, I believe in VC, but I don't think it's applicable in many. And I think as we go on, it'll be applicable in a smaller set of companies. And in some ways, they're happy because it would be great if founders actually self-select themselves out and say, after reviewing and talking to people who've gotten venture, this is actually not the best path for me in my company. Many times I've had to advise founders that it's actually you're going to be wasting months, and you're going to barely get capital, and you're probably going to make sacrifices that you don't want to make. And that's not an ethical issue. There's nothing wrong or right about it. It's just how things work. Just like if you choose to IPO, you're going to be spending 6 months of worth of your life and then or answering the quarterly results, right? Like trying to get there. Like that's not good or bad. There's no inherent ethics in that. That's just a thing. So founder one, define what success looks like.
I got a question for you. Yeah. I got a question. But before we go on to that, I got a question. What are you calling this area of venture that's like not $1 billion company, but above 100 million? Like, what's that kind of? You got
Yeah,
a name
no,
yet?
I call it SMV, small to medium venture, for now. But that's actually part of why I started the project that I did, because I wanted to name and normalize these things. I realized we as a species really like to name things before we back them. And before they're named, it's really difficult to back.
Yeah.
And you'll see, spend a lot of time, like any movement, social, cultural, financial, you need to package it. And it's easier to get any forward movement when you package it. So one of the reasons I actually started this project was because I wanted to do three things. I wanted to name these things, normalize them, and create incentives for them. And the reason for this is a personal mission of mine, which is what I have seen around the world is that we will live in a safer, more secure, more resilient world if we encourage entrepreneurship in all the forms. And I felt that non-unicorn path founders were not well supported in that journey. Go get debt, go beg your uncle, go see if a charity wants to give you money. And it's like, but these are real businesses making real money, able to make real impact and change, able to really convert a problem and solution into dollars. Like, we have to have a better answer for that. And fortunately, I wasn't the only one that did this. This was not just a thought, it's happening all over. So I call them, right now I call it the emerging asset classes that I have seen so far are SMVs, permanent capital, which is when there's no exit involved. I think that venture studios arguably are a new asset class into themselves because they are a very, very different model. They have a very different structure than almost any other venture. And there's a couple I'm paying attention to but haven't yet risen to the level of being funded well. I'm quite interested in sovereign innovation. These are innovation pursuits that are in the benefit of a country or region, specifically for different reasons of national interest. And I'm also quite interested, although nobody's really formalized this yet, in funding for very agile, very fast-moving companies, because I think one of the things that AI is going to mint a lot of companies are going to move super fast and be quite small, quite agile. Haven't seen any companies yet funding that. I'm paying attention to it to see if it actually emerges. But right now, SMV seems to be pretty well established. I found many, many, many different companies. Have you heard of, like, don't chase unicorns, chase camels? Have you heard that before?
Yes.
There's a company in the Nordics called Gorilla Capital that invests only in camels right now that exists.
Wow.
It's not just that. That's a lot of the stuff that I'm doing at Post Unicorn Capital is trying to track all this and figure out like who's doing all the really cool stuff. And there's a lot of really, really interesting companies. Some have been bold enough to put on their website this exact thing, that you don't need a unicorn to define your success. You need to solve a problem profitably and get a return to your investors. Have you heard of redeemable equity?
Yes, I have.
So that's another tool that has emerged literally in the last couple of years to shift this. Back to your thing.
Wow.
So if I'm a founder, first thing I'm doing is define your own success. Don't let anyone choose your definition of success. It's not a destination you inherit, it's a destination you choose. So that's number one. Number two, once I define my success, then we can talk about how you can fund it, because there's a lot of other options. There's seed strapping, right? So a lot of companies are doing that. They're only investing in 1 or 2 rounds. So you kind of map out, okay, how do I get to that success point? Because I can decide that. And a simple fork is, am I venture backable? Do I think this company actually needs multiple rounds of funding and lots of money to go after a globally market company? And I'm willing to put the effort into doing that. If the answer is yes, great. But I also want to give you perspective. You're competing against fusion companies. You're competing against pharma companies that are curing cancer. You're competing against the company that I'm doing, Palafox. We're doing a lot of physical AI in changing industry and changing maritime. We're looking at autonomous cargo ships that cross the ocean and electric propulsion systems. Be honest with yourself. As an investor, can you compete with that? And if the answer is, yeah, no, I think the thing that I'm doing is so cool that can compete with that, by all means, friend, go after venture. Seriously. But you should have a litmus test. You can't just think that, I'm a slightly better menu app and that's suddenly going to be interesting to venture investors. So that's a good thing. And be honest. The more honest you are, the better. And if you are sitting on that next idea, absolutely go after venture. 100%. Because venture, to be honest, venture is the only thing is the not the only, but the best economic tool you probably have for success. Does that make sense? Like that, that's important.
Yeah,
So if you're venture backable,
totally agree.
go for it. And if you're not, then let's talk about what the other ends. And I have had conversations in the last year now with founders. Can revenue get you there? And if not, why not? And what can you do? And I've had several founders figure out, hey, you know what? If I just pull $1 million or $2 million off a simple round, I can probably get there to the point of profitability and even pay them back. So some of them have even, considered convertible loans with the intent of paying them off. Like this, there's a lot more options out there. Right. A convertible loan doesn't have to convert.
That sounds a lot better. And
For
I
many
don't think
companies.
I think the gap, though, I think a lot of founders just don't know about this stuff. Like, I've talked to maybe 50 founders a week, and I'm shocked when it's like, oh, I know what venture debt is. Oh, I know that I don't have to give up equity. They all think I have to give up ownership of my company if I want any type of funding. And I think the biggest gap we have right now is educating those founders on the possibilities.
But Chris, let's be honest with one another, because I talk to founders all the time. Some of them, not a majority, not giving a number, but some of them consider a VC check as the mark of success they're looking for.
100% facts. Yes.
That has to change.
Yeah.
The biggest shift that I tell founders is the VC check is the starting line, not the finishing line. If you truly, truly accept that into your heart, you'll know how to run your company. That's the starting line, not the finish line. And unfortunately, for many people, the social proof and credibility they're looking for is a check from a major institutional VC, as if somehow that's some sort of social credibility. I can tell you story after story, and I bet you can too, of founders who got that social proof and credibility, built a pretty decent business, sold it. I'm thinking of 3 different people right now that got to unicorn status and let's just say are not rich at all.
Yeah. The horror stories, man. That's not talked about enough, of giving up so much equity that when you do have a big exit, it's not really that big for you. It's big for your investors. Such a bad look.
No, like really low amount of money, like, still pretty middle class for building $1 billion company. So, and that's not even the ones that get pulled out, that get pushed out of their own firms. How many times has that happened? And I'm not trying to down the industry. Those risks are worth it when you're building something that's truly solving a global problem with a potential for a big market share and a potential to get us all rich. Those risks are because everything you do is risk, right? So let me just start with everything you do is risk. No matter what you do is risk. So that risk is definitely worth it when you do it. So that's what I'm saying is, we want to do startup education. A VC check is not a measure of success. It's just not.
Man, Ethan, this was incredible. I feel like we could talk about this like nonstop. Where can the founders find more of your content and support what it is that you're doing?
Yeah, thank you. I mean, follow me on LinkedIn. That's always good. I post a lot there. And you could also go to postunicorncapital.com. You can sign up on the email list to get notified. We're actually issuing a report later this year, earlier next year, because this is a mission of mine because I want to promote entrepreneurship. And I actually think it's good for venture as well, because I think if we get more quality venture deals and we get more quality deals in general that get funded, it's better for the entrepreneurship system. It will encourage more people to pursue entrepreneurship, which will then yield even more venture and non-venture ideas. So it's just a flywheel effect. So I'm working at postunicorncapital.com on a report that's trying to list all of the funds that I found in what I call venture adjacent funding, all the people that are trying to do experiments in capital innovation. And then, hopefully next year we'll do some conferences and try to get together people that are really want to build this venture adjacent ecosystem to say, we deserve to build companies, we deserve to define our own successes, and we deserve to get those funded and pursue and to make the world a better place in ways big and small.
I love it, man. Ethan, thank you for being here, being such an amazing guest.
Thank you so much for having me. It's a pleasure.